Hi everyone. In today's video, we will be discussing the key differences between shares and bonds. When you have money to invest, the big question of where to allocate is the most tedious of all. So, where does one allocate their funds? In our previous videos, we've spoken about both bonds and shares. Let's see now how they differ from one another. Having a well diversified portfolio is one of the most important things to do firstly, and shares and bonds are the most tradable assets in the market. Shares are equity securities issued by corporations and traded in the stock market, whereas bonds are debt securities that are traded in the bonds market. So, when we say bonds are debt instruments, what does it actually mean? Imagine you have taken a loan from a bank and now the bank is charging you some interest. When you buy a bond, you are the bank in that case that has given a loan to a company who is paying you interest. Therefore, this becomes a debt security. Bonds, in most cases, provide investors with a steady income that can be handed out quarterly, half yearly, and annually depending on the plan chosen. On the other hand, stocks are equity securities and are traded on stock exchanges. Now, what does equity mean? When we talk about equity or stocks, that means you have bought a very small ownership stake in the company whose stock you have. And when the company performs well, the stakeholders enjoy benefits as well. So instead of interest payment like bonds, stocks are bought on the belief that the company will perform well in the coming time period. When the value of the shares increases, investors can buy or sell those and make profits. Now let's talk about other major difference between shares and bonds, which is the risk involved. Stock market is highly dependent on socio-political factors, currency, liquidity risks, etc. While bonds are more responsive to interest rate risks. When the interest rates rise, bond prices fall and the owner is subject to a loss if he or she decides to sell their bond. It can also happen that company can default and can't pay the investors their money anymore. Such a risk is called a credit risk. Keeping these differences in mind and with the help of a financial advisor, you can create a portfolio that serves your purposes and allocates your assets where they can reap the most benefits. Investoscope Financials look forward to serving you. Thank you for tuning in to our video.